Many Canadians contribute throughout their working years to their RRSP and then get to a point at retirement when they are just getting clobbered with taxes and clawbacks. Most of them are left with a bitter taste, wishing they never contributed to their RRSPs in the first place. Does this sound familiar? Hi, my name is Darius Muica. I'm a senior investment advisor with Noor Private Wealth. If you are new to my channel, I focus on helping Canadians safely build wealth and pay fewer taxes. In today's video, I will tell you why at retirement your RRSP can become your biggest liability and what you need to do to avoid overpaying in taxes when it's time to take your money out. So let's jump right in. Just to be clear, an RRSP is an incredible tool, and if it wasn't for the tax deductions and deferral benefits, many Canadians wouldn't have been able to accumulate as much money for retirement in the first place. We can all agree that up to retirement, contributing to an RRSP is extremely efficient and is the right thing to do. If you are incorporated, the strategies I'm going to talk about might not be applicable to you. I've created a video for business owners that talks about a great alternative for an RRSP. You can find the link in the description below. If you are an employee and not sure whether contributing to an RRSP or TFSA would be the right option for you, I've created a different video that will answer this question exactly, and again, you can find the link in the description below. Now that we got that out of the way, let's focus on the RRSP at retirement because that's when issues may arise. The first issue is if you were to pass away, the RRSP would become the biggest tax liability at the estate. Unlike a TFSA that passes on to your beneficiaries tax-free, your non-registered assets would incur capital gains, while your RRSP would be taxed as income, which will most likely be at the highest marginal tax bracket. Because of the risk of losing half of your RRSP in taxes at the estate, you would probably want to focus on taking it out as soon as possible. Of course, you do need to keep in mind that each dollar that you take out will be added to your taxable income and could potentially increase your marginal tax bracket and can cause a clawback to your all-day security payments. Many retirees are tempted to tap into their non-registered assets first in order to take advantage of a lower tax bracket in the early years of retirement. They can face an unpleasant surprise once their RRSP gets converted into a RRIF, at which point the set minimum withdrawal rate can push their taxable income above the clawback threshold. For 2021, this threshold is $79,845. If you live in Ontario and your retirement income is $1,000 above the threshold, you will have to pay $314 in taxes and receive $150 less in old age security payments. This will leave you with $536 out of the $1,000 in your pocket. I always tell all my clients that the key to a successful retirement is paying as little as possible in taxes. Otherwise, it would be the equivalent to spending your working years filling up a bucket with water and realize that it was all along leaking from the bottom. So what should you do to avoid this? 1. Be aware of the issue as soon as possible. Ask your financial advisor to make projections and see if your income could be above the clawback threshold at retirement. Maybe even consider not making RRSP contributions while you are still working but getting closer to retirement. 2. When you retire, don't tap into your non-registered accounts. Instead, try to take as much as possible out of your registered assets. Doing this can help you stay in a lower marginal tax bracket in the future. 3. Allocate your lowest growth or safest investments to the RRSP instead of TFSA or non-registered accounts. Your active focus should be to see your RRSP assets decreasing and your TFSA and non-registered assets increasing. This will help you throughout retirement to avoid old-age security clawbacks, stay in a low marginal tax bracket, and leave as much as possible to your estate. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button. And if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.